So let's start at the top, maybe with the either gross income, or let's go with deductions for gross income, or sorry, deductions for AGI. So these are really the business items are related to business, and we will eventually get to those. The rest of these are largely focused on individuals. I've highlighted in red some of the more common ones, but we'll just blow through the list really fast. Educator expenses, that's a small deduction that certain K through 12 educators are allowed to deduct. There's certain business expenses when you are an employee, as long as your employee is a reservist, a performing artist, or a fee basis government official, that you can deduct. The rest of us aren't allowed to deduct unreimbursed employee business expenses. Health savings accounts are a little bit of a lockbox if you have a high deductible health plan at your work, or you don't have one at all. You can use a health savings account to set aside money and use it tax free for healthcare. Moving expenses used to be a broader for AGI deduction. It's now limited to members of the armed forces. The next three are big ones, though. The deductible part of self employment tax. As you know, we've been through a calculation of employment taxes. And uniquely, when you're self-employed, you pay both halves. So to be fair, since if you were, for example, a corporation, you would be able to deduct a part of that. When you're self-employed, you're eligible to deduct a part of your self-employment taxes as well. Same with contributions to a qualified retirement plan. And same with your health insurance, right? If you're an employee, your employer can pay your health insurance. It's not includable. We'll get to that when we get to gross income exclusions in a little bit. And this is where, if you're self-employed, you get a chance to deduct those same costs. Penalty on early withdrawal of savings. That's exactly what it sounds like. Alimony, we'll get to. Definitely covered more as an individual topic. The IRA deduction, so a deduction for a contribution to an individual retirement account. So think of an IRA as being someone who doesn't have access to a otherwise qualified pension plan. Now that's not exactly true. You can have access but have low income and still make IRA contributions. Student loan interest might be of interest to you if you're borrowing right now to get yourself through school. Eventually, you'll be able to take your student loan interest deductions. Reserve for future use, I guess, is reserved for future use. And Archer MSA, those are dead. I mean, there still could be taxpayers out there, but those haven't been available to start for some time. So they're kind of a legacy thing. Okay, well, that would take us down to AGI. Then we would focus our attention on deductions from AGI. And we start generally with a standard deduction. You're eligible to take the greater of your standard deduction or the total of your itemized deductions. And as you can see on this slide, your standard deduction changes based on your filing status, and eventually we'll get to filing status. These also change every year, so these are not numbers you need to memorize. I think it's useful if you're an actual CPA or a tax prep person to understand about where they are. Married filing joint about 25, singles about 12,005, and head of households about 19 grand, just so you have a sense as to, when you're maybe comparing that to itemized deductions. Note there are special rules if you are claimed as a dependent by a different taxpayer. You are not eligible necessarily for that big standard deduction. You get a much reduced one. And if you're aged, if you're old or blind, you actually get an additional standard deduction. So I don't think there's any policy argument with blind, although you could certainly chuck in deaf or any number of other sorts of challenges that individuals can face. But as it turns out, there's only an additional one for blind. And the age is 65 or older. You get an additional deduction if you're 65 or older. That's basically just political kowtowing to folks who vote a lot. That should almost certainly be needs-based under any circumstance, but it's not. And so rich or poor, if you're over 65, you get an additional standard deduction. In 22, the amounts are, as I mentioned, adjusted by inflation every year. You can see they increase. If you do a quick comparison, you'd see that married filing joint, they're all up by some amount. The dependent amounts are up slightly, and some of the aged and blind are up, if depending on whether you're single or married filing joint. So again, not required to memorize any of these amounts. These are more for illustrative purposes, and you do need to understand that they exist and that they're based on filing status. Here's the itemized deductions that are eligible for at least this year. And, I've highlighted them off what is a Schedule A. Schedule A is where you would report your itemized deductions to the extent you're going to. You can see that it's medical and dental expenses, taxes you paid, interest you paid, gifts to charity, casualty and theft losses, and then there's a handful of other itemized deductions that tend to be pretty obscure, but do pop up every once in a while. Gambling losses get reported there. If you have an annuity that you never recover the basis in before you die, you get to deduct it there. So there's a handful of really bizarre things that go into that category. The others are pretty straightforward. You may or may not have heard of them. Many of them have caps or limits. Let's take medical and dental expenses as an opener. If you look, for example, at line 2, it says enter the amount from the 1040 line 11. That's adjusted gross income. And so that's probably last year's file, but neither here nor there. It's certainly a draft version, whatever the case. And you can see that you then multiply AGI by 2% and then subtract it from the total of your costs in line 4. And what that's saying is you don't get to deduct your medical and dental expenses until they exceed 7.5% of your AGI. And I think we talked about AGI being like a dividing line about ability to pay. And this is really saying, look, you can deduct medical and dental expenses when they're reasonably catastrophic to your income. Otherwise, no, those are just personal expenses and can't be deducted. Taxes, draw your attention to line E, where it's the smaller of your actual taxes, or 10,000. That's an important number. It's been politically bandied about now for, 4 years, 5 years maybe, about raising what's called the SALT cap, state and local tax cap. So definitely is an interesting element in politics in that increasing the SALT cap almost certainly favors wealthy individuals, and yet the Democrats were pushing for it. So it's always weird to see something like that take place in the tax policy arena. It doesn't happen very often. Interest you paid is basically line 8 for the most part, home mortgage interest. There's a deduction for investment interest down on line 9. So rather than cap the amount of interest that you pay, instead they cap the amount of debt you can incur and take a deduction for. So the current cap is $750,000. So your mortgage up to $750,000, the interest on that is deductible. If you have an $800,000 mortgage, then you'd actually have to prorate that. A portion of it would be non-deductible. Gifts to charity, charitable contributions are deductible. Casualty and theft losses are a fairly limited deduction these days. It's only if that loss is associated with a federally declared disaster. And we talked about other. So the other from AGI deduction is the QBI, or qualified business income deduction. That's 20% of your qualified business income. So think of that as the income you might generate from a Schedule C or from an operating business partnership investment, something along those lines. And the basic rule is 20% of that amount gets treated as a deduction. However, it's way more complex than that, and eventually we'll just cover the QBI deduction in its totality. I think it's chapter 15. There's a whole chapter set aside to nothing but that calculation. But in this example, we have a taxpayer who has wages. They have some business income. Their total AGI, $15,000. They take a standard deduction rather than itemized in this case, I guess. Then you see that they take their business income, multiply that by 20%, and take that QBI deduction, and that drives down their taxable income by 20% of that.